Well, hello, everyone. We're so glad that you're with us. And we are so excited that we have Kim Painter with us. She is an accounting partner and CPA with Barnes, Brock, Cornwell, and Painter. And we are answering a lot of questions today on what is your best business structure? Should you do a C-Corp, an S-Corp? What's deductible? What's not? Should I do mileage versus actual? What's the best software? So we are super excited that you're here. We would love for you to type your questions in the chat. And Kim, welcome.
Thank you. Glad to be here today.
All right. So let's talk about what is the different things like C-Corp, S-Corp, LLC. If someone is a real estate agent, what do you recommend and why?
That's a question I get very often. And I just want to kind of briefly tell you about the structures, but to answer that question, S-Corp is what I always tell my real estate agents to set up their businesses as. The LLC and S-Corp are both corporate structures that are separating yourself as a business structure away from being like a sole proprietor. Both of them have what they call the veil of protection for liability for someone to sue you personally. So you have that protection. But for an S-Corp, you're not subject to self-employment tax, but an LLC, you are. So when I usually talk to people about this, just to give really broad numbers, if you're an S-Corp, on average, just say you're in the 15% federal tax bracket, and Virginia is about 6%, 5.75 or 6%. That's a total of, just say 20% to round. And then if you have self-employment tax, that's another 15%. So you're paying 15% additional taxes to be an LLC versus an S corporation. So it's definitely better to do the S corporation. And there's a lot of things I could talk about because people say, well, they tell me I have to be a salaried and things like that. So we'll probably talk about that a little bit later. But the structure itself would be an S corporation would be my recommendation.
Okay, so let's talk about that. If you want to be an S-Corp, let's talk about the salary that you have to give yourself and how you have to place employment taxes for that.
Okay, so to what the IRS says, the IRS regulations say that you have to have any business has to have the owner has to have a reasonable salary based on their income. And so what I do is I always keep up with the court cases this is going to court with to see kind of what numbers that they're using to determine what is reasonable, because reasonable is a very broad word. So there isn't a steadfast, this is what the dollar amount is. This is, what it is that you have to have a salary for. Reasonable, you just have to go back to court cases and see who actually has gone to court and what they've made them do. So the court case that I kind of have kept up with, the last one, that's the most recent one, it was a professional doctor that had no salary. His net income was about $300,000, and they wanted him to do a $50,000 salary. So what I tell, especially my real estate agents, your net, I don't really do a salary for anyone if their net is under $100,000, and that's your gross 1099 minus all your business expenses to come up with your net number. Because when you do salary, you have to pay all the employment tax, which is the 15% I just talked about that you're not paying as the LLC. But you don't have to do a salary for the full amount of your net. So people kind of get confused about that. So what I tell people, we can just do a reasonable salary, like $10,000 or $15,000 or something like that, just to pay into the government. So the one downfall that I need to make you aware of is when you're not paying either salary or LLC, you're not paying Social Security. That will affect your earnings down the road when you want to go collect Social Security when you're of age, in your 60s that you want to collect. If you have a W-2, all that wages goes towards what you're going to get from Social Security. If you're a 1099 and an S-Corp and you're not paying into Social Security, you probably will have years that you're not paying anything. So that could affect what you're getting down the road. Some people tell me it doesn't matter. I don't think it's going to be there when I get to that age. Yeah, I hear all kinds of things that people tell me. Some people say, I just want to start my business now, and as I make more money, I'll do payroll then. So it kind of is all over the board, but I would recommend at least starting out that you would go a couple of years and not have to do payroll, just to save yourself some money and get going. And then, talk about payroll maybe like in your third year.
So I want to recap a little bit so people really understand. So S-Corp, you only pay regular income taxes and no self-employment taxes on your distribution. So the current self-employment tax rate is like 15.3%. Therefore, if you have an S-Corp, your income is not subject to that self-employment tax. So basically, by doing an S-Corp, you're saving that 15.3%. Is that what I heard you say?
Yep, that's exactly correct.
Okay. So that's a really big reason of why you should be an S-Corp. Then you also said, if you're not making, let's pretend an agent is making, you had talked about the $100,000 mark. Let's say that an agent is bringing in approximately $50,000 a year. Let's just say they're brand new. They're only making $50,000 total amount of money for that year. Are you still suggesting that they do an S-Corp? Why or why not?
Yes. Anytime you have any net income, if you don't do any type of corporate structure, you are considered a sole proprietor. When you're a sole proprietor, you're paying federal, state, and the Social Security and Medicare or the self-employment tax. So anytime your net's over, $1,000, you want to set up the corporate structure. The only thing you have to think about once you do that corporation, the S-Corp or the LLC, if you decide to go that route, there is a separate tax return you have to file. So you do have 2 tax returns that are filing. So that could create an additional cost to you to get 2 tax returns done. But overall, it's still going to save you money with what you would have to pay in the self-employment tax to pay a little more to have income taxes done. And then you'll have an annual fee to keep your corporation or LLC open every year that you have to pay to the State Corporation Commission. That's anywhere between $50 to $100 to keep it active every year.
So is there any reason why an agent would want, as far as their best business structure for a real estate agent, is there ever a time where you would say they should do an LLC instead of an S-Corp that you can think of off the top of your head?
I don't have any, no, honestly, no. The LLC structure is really, the benefit of the LLC structure is for real estate holdings, not real estate agents. So if you own real estate, most rental properties are set up in an LLC. That is the biggest benefit to an LLC, is to use for rental properties or second homes or things like that. But because you don't have the self-employment tax, because that's passive income. But for a agent, no. The only thing I could think of off the top of my head is maybe if you have 2 people, that would be the reason to set up an LLC. Maybe you have 2 people that are working together that somehow are splitting, expenses, and they want to do an LLC for some kind of legal purposes or something.
So explain, if you do have a rental property, why is it important to put it in an LLC?
It's really not a tax situation, because an LLC as a rental property is still shown on the Schedule E for your personal return. The main reason you want to set it up is for insurance purposes, to protect you from liability. So when you have a rental home, you're always have that issue that someone can get hurt on that property, and they could come back and sue you if you didn't have it in some type of a structure. If it's in just your personal name, someone falls down the stairs, if they get hurt, they slip, anything can happen on a rental property, and they're always going to try to come back against the homeowner as the person that's liable, because they'll say, it wasn't set up properly or something. Especially if you have a pool or any type of structure like that is, high liability. Definitely you want to do the LLC. So it's mainly just for liability purposes to protect you and your assets.
So let's say that one of our questions that people are typing in the chat, Michelle asked, is it difficult to switch from an LLC to an S-Corp? Because lots of people have gotten bad advice and they've said, oh yeah, get an LLC. And, people that got terrible advice. If they want to switch from an LLC to an S-Corp, when should they do it, first of all? And how hard is it to switch?
It's not hard at all. And you don't really change your name or anything. You still keep your name as, whatever with LLC at the end of it. And you can do that right away when you start the business, or at the latest time you want to do it is when you file your tax return for the company. And you have to do 2 forms to do that change. And they're just with the IRS. So basically you're changing your classification with the IRS is how you want to be taxed. So you can keep your structure as LLC, but you can be taxed as an S corporation. And all you have to do is file its Form 8832, which is change in classification. And that changes you from an LLC to an S corporation. And then there's another form called 2553, and that's the actual S election to be taxed as an S corporation. So those 2 forms are the only things you need to send in. As soon as possible, you should send them in, but at the latest, you can send them with the return when you file your first return. Or if you've been operating as an LLC for years, you can still change to an S corporation, but it would be, as of the year that you're going to do that at that time. So you can make that change anytime, not just when you get started.
Do you think that they should wait to transition that on January 1st? Like, for example, right now we're already in September. So just saying, you know what, because otherwise they're going to have to file part of their year as an S-Corp and part of their year as an LLC. Would it make more sense to just say, look, just make it effective January 1st? You already are an LLC, put everything as an LLC. Otherwise it gets messy with taxes.
I would say the only reason I would wait is if you don't have much income from now till the end of the year, that would make a difference for taxes. So if you just say right now, your income's 50,000 as of this point in time, and then you project it to be another 25,000, it is worth it to still change, because that at that point, you're still going to have save in taxes. As long as you're going to have income. If you're not going to have any more income, then there's really wouldn't be any sense to change. But if you have any income between now and the end of the year, I would definitely go ahead and change. You can actually make that election to change it back to the beginning of the year. So as of today, if I decided, hey, I realized I set up the wrong structure, I want to be an S corporation, it's called a late election. You can file a late election to be changed to an S corporation. And I'm not 100%, but I think it's 24 months after you make that decision, you can go back. So if I wanted to make that change today, I can actually backdate that to January this year and do a late S election. So I would say you wouldn't have 2 returns at that time. You would just have the one, and you can backdate it.
So another question is, what is the major difference between an S-Corp and a C-Corp?
A C-Corp is where the company itself pays the taxes, and an S-Corp is where the person that own that pay the taxes. So as an S-Corp, what happens, a tax return is filed with all the income and expenses for the corporation, and then the owner or owners get what's called a K-1 form, and then they file that with their personal taxes at the end of the year. Excuse me. So that net income number, just for instance, say your gross is 100 and you have 50 in expenditures and your net's 50. So, and I'm a 1-person S corporation, I would get a K-1 that says my income from this S corporation is 50,000. That 50,000 then goes on to my personal income tax return, and I pay taxes individually based on my income tax rate individually. So if I have, a spouse and they work in W-2s and rentals, all that just gets added to all of your income and shown on your personal return. A C corporation, the corporation itself pays the tax based on the income. So say that same scenario, I have 100,000 gross, 50,000 net. The corporation pays the tax on the 50,000. But for me to get money out of that company, I would have to take a W-2 to get it out, and then I'd pay all those extra taxes. And a lot of people say, you'll hear a lot that say C corporations are double taxation, because the corporation actually pays taxes, and then the person or people that own it want to take the money out, they have to pay taxes because they have to take it out in payroll, or they'd have to take dividends. So they're basically taxed twice, corporate level and individually. And then like the S corporation, you're just taxed on your rate based on whatever your entire tax rate is.
And now a word from our sponsor. This episode is brought to you by Canzel Realty.
One of the other things we give you is revenue share, where you get 5 levels of money in your downline every time you attract an agent to the company. And guess what? The first 3 levels open up right away. So let's pretend like you're not a great recruiter, but you bring on a couple people who are heavy hitters. Guess what? You don't have to hire 5 or 10 agents to open up those tiers. You automatically get those. So that's what makes us very different.
This is Canzel.
So originally when I started in real estate, I always have had an S-Corp. And just so you know, we had to change to be a C-Corp, because the only way for our company to go public is to be a C-Corp. So our company is a C-Corp because it's the only way for us to go public. So we actually had to change from an S-Corp to a C-Corp. Another question is on the topic of buying investment properties with others. Can you explain when it might be appropriate to have a LLC structure versus have an LLP structure versus an LLC in Virginia?
The LLC, and this would be a lawyer probably question more than me. Limited liability partnership. To me, they're both taxed the same. So I would probably refer that question to an attorney of why the different structures, because as far as income tax is what I do, LLC and LLP are still taxed at the same as a partnership. So just to say the rental property, if you're a single person that owns rental property, and I said just put it in an LLC, you can have multiple owners of an LLC or an LLP, and it's the same thing, that you're still protected, but then you're going to file a separate income tax return if you have multiple members, because they each have to get a K-1 for that. They're part of the ownership of that company, and then that goes on their individual return.
Yeah, so let me explain that for those of you who have never even heard of an LLP. An LLC offers personal liability protection from any debts or lawsuits filed against the business and for all the individual members. So, for example, if you had an LLP, as in Paul, the partners aren't personally liable, but only for their own negligence. So, for example, if you were in a partnership with me, Susie, and Pat, and one partner was just a wackadoodle, and you're like, I don't want to be responsible for him. If he does something wrong, maybe we should go into an LLP. But I personally think that an LLC would be better. But again, you would need to talk with an attorney. But in my opinion, if you're going into business with someone that you think is kind of a ticking time bomb, and you're like, I don't want to take responsibility for the things that he does, you might want to just rethink going into business with them anyway. Okay, perfect. Let's talk a little bit about tax savings. So we're all trying to save money on taxes. Give us some items that maybe people don't think about that would be deductible for real estate agents, and they're just not even using those.
Sure. A lot of people pay things personally that they may not realize that they can take as a business deduction. Of course, any direct expenses that you pay, like dues and education, gifts, things like that, you're paying out of pocket are all deductible. The things you may not think about or don't understand completely is your like home office. So home office deduction is a great deduction for real estate agents because you don't really have an office that you work in. So you're allowed to take the home office deduction. And in that point, when you do that, you have to figure out what percentage of your home that you're going to use as your office. And that would be as a percentage. So usually square footage is the easiest way to figure that out. So the room you're using versus the entire square foot of your home. And then what you can do is take a percentage of all your expenses, your utilities, at that percentage and write that off as a home office deduction. You can also take 100% of your internet for home office and 100% of your cell phone for as a deduction. At some point, people used to think, well, I had to take only 50% because it's still personal use. The IRS changed that for both internet and phone to make it 100% deductible, even though you use it some for personal. I also get the question, well, we have a family plan on our cell phone that we pay like $150 and then each phone's $30 on my plan. So what I tell people at that point, the real estate agent should have the main part of the plan and have it structured like the agent has the plan, and then you can add your kids or whoever else you add onto it. Then you would take the full base amount, like the $150, and then the $30 for your cell phone, and that would be the monthly deduction you get for cell phone. The other thing, a big deduction for agents is mileage, business mileage. So the easiest way I tell people to do this, and I've been through several audits with the IRS with mileage and not agents, but other people. So I kind of know what they look for. They want, I always tell people, try to write your mileage down. Some agents have like apps that are great that have exactly what they go, but some people are like, that's just too much. I can't remember. So what, if you can write down your mileage on January 1st and December 31st, so you know exactly how many total miles you went during the year. And if you forget to do that, maybe you had your inspection or something, or a car repair, something that would show the mileage, close to a year's worth of time. And then you can estimate your business miles if you want. But what if you do get audited for business miles? The IRS wants to see basically like a calendar or something showing your appointments and possible miles for each appointment. So if you don't want to do an app or something to get actual mileage, you can use an estimate based on percentage of business use. Some people have one car, then they just say, this is my 100% business use car, and we use our other car for personal. So whatever's easier for you to track that. But mileage is usually higher. So you get either the higher of actual or mileage, whichever is higher. And if you do actual, you would add gas, repairs, insurance, any type of car payment, but it would only be the car itself. You would take the interest in that, and then you would depreciate the vehicle itself. But I've never, in all these years of doing this, over 30 years, I think I've had one person that's actually benefited them. Mileage is usually always higher.
Real quick, back to the taxes. Could you repeat the forms that someone would do, as if they would need to do for an S-Corp or if they would need for an LLC? What are the forms they need?
To change from an LLC to an S corporation, the forms are 8832, and these are IRS forms. Form 8832 and Form 2553.
Now, let's talk a little bit about, let's say that somebody is deciding whether they want to purchase their car or lease their car. I think everyone kind of has different thoughts on that. Is there a difference on if they want to expense the vehicle? What do you prefer, purchasing or leasing?
So once you decide to do whichever way you go, whether it's actual or mileage, you have to stay with that for pretty much your business. So if you decide to go actual, then there is one big benefit for vehicles is if you buy a vehicle over 6,000 pounds, it's a bigger SUV like Tahoe, Suburban. I'm trying to think of there's the gross vehicle weight over 6,000 pounds. You get the write-off of pretty much that entire vehicle the first year you buy it. So that vehicle would be written off 100%. And then you also get all the actual expenses for the vehicle. But once you do that, the next year you have to take actual. So it's gas, all the things I just said earlier, insurance, all the repairs and things like that. So you're going to have lower deductions in future years, probably, than mileage. So you have to weigh your options. Is it worth it to get that big deduction right off the bat? Now, if you lease a vehicle, if you lease to own, you can consider it your vehicle if there's like a bargain purchase option at the end that you can buy it for, a cheap amount of money. But if you're actually just doing a straight lease, then you would take you could do the same. It's either mileage or actual, but then you would take the entire lease payment as your actual amount as the deduction for the actual expenditures.
Yeah. And that's section 179, where you can get so much money back on that vehicle. I guess people now are thinking, okay, well, with the price of gas, right? Like, yeah, I'm getting this great tax deduction, but that's also costing me a lot more money in gas. So it's kind of weighing that option as well.
And the mileage rate changes every year. So it's been running in the last several years anywhere between 55 cents to maybe 59 cents a mile. So if just say you went 10,000 miles, you're going to get, at least 55, anywhere between 55 to, up to $6,000 of a write-off just on 10,000. And most of my agents go, way over 10,000. So just say you went 20, you're going to get, $20,000. At least like, $12,000 of a write-off, which is going to be usually more than what you're actually spending on actual expenditures.
Another question is, do you have to pay cash to deduct that vehicle on year one?
No, you can get a loan for the whole car.
Perfect. Let's talk a little bit about, for someone kind of keeping track of all of these expenses, if they wanted to do it, what are your favorite software for people to do?
A lot of my clients use QuickBooks. It's very easy to use. And some people you don't even need to put the income in there, because you'll get your income on the 1099 at the end of the year. You just put your expenditures in there. I know there's a lot of apps. A lot of people just will print a report and send it to me. And I should ask more about what they're using to be able to recommend different softwares. Some people even use like a Quicken, which is what was before QuickBooks was out there, just to keep like a check register to itemize your expenditures. And that's all you want is a software that can itemize what you're spending based on the category you're spending it for.
Yes. Let's talk about contract labor and 1099. One of the things we're constantly trying to teach our agents is, they get in this mindset of just like, I'm just going to do more stuff myself instead of delegating things out. And, I'm going to write a book called How to Delegate Everything But Sex. And that's going to be coming out in the next year or so after I get all my content in, because I love to delegate everything out. And I think hiring contract labor 1099s to help you with all of this stuff is the best way to go. Give us some tips on kind of the best way to handle contractors for 1099s and making sure that you're able to write that off, and just any other tips in general for them to kind of keep everything separate of what they need to do.
Yep. So if you have someone that's helping you out, doing maybe administrative, helping you, whatever they're doing for you in your business, if you pay them in a calendar year over $600, you have to give them a 1099. If you pay them $599, you can write that off as a deduction as contract labor and not give them a 1099. Once it hits $600 or more, you have to issue them a 1099. Then they are going to be paying all those taxes that we talked about at the beginning. They're going to pay the self-employment, the federal and state taxes and all for helping you out. So you want to make sure that they're aware of that they're going to get that, but it's definitely going to help your taxes because you get that write-off. A lot of people are like, I don't want to give them a 1099, so I'm not going to worry about deducting it. Well, if you are paying someone to help you, that's fine. If you don't write it off, you're basically paying their taxes for them because you're taking that write-off that you could have taken and not deducting it. And so you're going to be paying more income tax, and that person's not going to be paying any tax. So that's not really a smart business move to make sure, that you're getting the best tax deductions. Plus, you want to make sure you really know what you spend on your business. Are you spending too much money? Are you still making a profit? When you don't write off certain things that you're spending, then you really don't know what your bottom line of your business is. And as far as other deductions, I made a list of some things. I just wanted to make sure I covered. So, and I'm just going to read them off. Some of these I already talked about. So internet, cell phone, business miles, dues, education, business meals. That's a great deduction. So make sure you take meals when you go with clients. What you need to do on the receipt for business meals is write on the receipt who you went to lunch with and what you talked about. That's all that would substantiate an audit. So make sure you keep up with that. Office supplies, people don't think too much about that. Like if you have a home office and you buy a printer or a computer, the paper, the ink, everything that you're using for those electronics, file cabinets, all those are deductible for your business. So anything you're using at your home, a desk, chair, things like that for your home office are all deductible. Postage, advertising, we talked about contract labor. Insurance, I would recommend, and I don't know if Chantel tells your agents to get an umbrella insurance policy to cover anything that may come back on you for any reason whatsoever. They're not very expensive, a couple $100 a year for like $1 million policy. I do try to recommend that to people. Professional fees, home office, gifts, and then any other expenses. So I covered most of those items earlier.
I love that. And if you are not, someone just typed in the chat, it's very good that you have to have one credit card exclusively for business expenses. And then you can have those credit card statements can automatically be downloaded directly to QuickBooks or Excel, which is really, really important. And buying leads, to me is one of the best ways for you to have a write-off, because talk about a win-win. You're getting that tax deduction. And like we talked about with Canzel, you have that platform. It's KV Core. You have those leads that you're getting. You're getting it as a tax deduction. You are cuckoo for Cocoa Puffs if you are not buying those leads. And the best way to do it is they do something where they boost your listings. And those are really, really phenomenal leads. So I want to encourage you on this call. You should be spending some money on leads. If you're listening to this call, you should look in the show notes for the podcast. We have this great system that we just put together. They gave you free leads. It's got about 20 different places where you can get free leads from. And it is amazing. And you'll just go in and sign up for each of those free leads. But I think I want to encourage all of you guys also listening, stop being cheap is what I want to say right now. And I'm going to get fired up because I am so tired of you agents being so darn cheap. Pour back into your business. That is what I have to say to you today. Everyone at our office today is like, Chantel is fired up. I get like this every once in a while where I'm just like fired up. I'm fired up today. This is a business. Put marketing back into yourself, put leads back into yourself, and stop being cheap. Any other advice? And guess what? You can use it all as a tax write-off, right? So it's win-win. Kim, what final things do you have to say today?
I would just make sure if you're a new business, you start yourself off the best way you can from the start. I always tell people, you don't want to pay the government, you want to pay yourself. So set up your structure of your company the best way you can to make sure you're putting the most money in your pocket than you're giving to the government because you're working hard. So make sure you're doing what you can to keep that money. And so to help yourself, your family, everyone else, and pay the government what you need to, but not more, than you need to. So just make sure your structure is set up correctly at the beginning and you understand the different rules and regulations so you know what's the best for you. And make sure you get all your tax deductions. That's very important.
Awesome. Thank you so much for being with us today, Kim.
Glad to be here.
Yes, we are so glad you're with us. That was so much great information. So you guys stay tuned. We've got another episode coming up soon.
Thank you for listening. If you enjoyed this episode, please subscribe, leave a rating and a review so we can get this out to more agents. And tune in next week for another power-packed episode. This is the Millionaire Real Estate Podcast.